My credit score impacted my home buying journey in so many ways, like so many ways. So in this video, I'm going to highlight those 3 ways. And then I'm going to highlight 3 things you can start doing right now to improve your credit so that you can get the best terms as it relates to your home. So the number 1 way that my credit score impacted my home buying journey is with my pre-approval. So my pre-approval and your pre-approval basically has the terms of what you can go out and buy. It has usually the purchase price, the interest rate, the loan that you consider, and that's where you want to pay attention. You want to pay attention to the loan type, because the 2 main loan types that people usually go for, especially first-time home buyers, is the FHA route, which is a government-backed loan. They often have a lower credit score requirement, but then there's also the conventional route, which is privately backed by banks and things like that, and they often require a higher credit score. So if you want to have options, which is what I wanted, I want to be able to consider all of them. I don't want to have to go with one or the other, because each loan type offers benefits. So that required me taking a step back and actually going through the 3 things that I'm going to walk you through in this video. So stay tuned, do not click off. I'm going to wrap up these other areas. 2 is that it impacted my debt to income ratio. So debt and credit go hand in hand. Debt can be credit cards, it can be student loans, car notes, medical bills, all of that. So the goal, and my goal, which should be your goal as well, is to have a debt to income ratio that is as low as possible. The lower it is, the better that's going to be for you, because that basically is something that lenders use to determine how credit worthy and how confident they are in lending to you. No one has to, I mean, some people do, but most of us don't have $300,000, $400,000, $5,000, $1 million laying around to buy a house in cash. So your lender is going to be your bread and butter. That's basically the parent, the rich uncle, the rich auntie, the rich grandfather that we all need, but we have to pay them. So whatever they pre-approve you for and whatever your debt to income ratio is going to be good, because that leads to point 3, your interest rate. So every loan you get, whether it's a car, student loans, has an interest rate. And so the higher your credit score is, the more likely it is for your interest rate, the rate that's attached to your home loan, can be. So I spent a long time working on my credit score so that I can get a low interest rate. And I highly recommend you do the same as well, because a low interest rate can be the difference of you paying $200 in interest to $700 in interest. You know, 2.9 versus 7.7 is 2 different interest rates. So we want to get as low as possible when it comes to an interest rate, and a good credit score contributes to that. So those are the 3 reasons and the 3 things and the 3 ways that my credit score impacted my home buying journey, and it forced me to take a step back and get my life together financially. So now let's talk about what I did to actually improve my credit score. Number 1 is that I only used 30% of the utilization amount in my account. So every credit card has a utilization max. Some of you can have 6,000. My first account only had 6,000. My first credit card, my utilization cap was 6,000. So I could not spend more than 30% of that 6,000, because it's all about management. It's about credit management, and it's about budget management. And so they want to make sure that you're not maxing out these cards on a monthly basis. Have I maxed out cards before? Not perfect. Life hits us all very roughly. But did I eventually pay those things off? Absolutely. So it's just a good practice, a good credit practice, to spend only around 30% of it, because you know, and you likely are confident that you can pay that off. So what can that 30% include? Normal expenses. Back then I had, again, a traditional regular car. I just put simple things on there, like my utility bills, stuff that was recurring, that was small, not super large. Now my credit, utilization amount is much higher. So what am I putting on there now? So I have another card that I'm thinking of. My other card now is a travel card. And so, work hard, travel hard. And I put travel related expenses on there according to what they will give me. So that's flights, hotels, dining out, any kind of ride share, stuff like that, anything travel related. allows me to earn additional money, and so I don't put any of my major bills on there, like my mortgage and stuff. I mean, you can, I just personally don't, because it doesn't benefit that card that I have. So that allows me to, point two, pay off my loan, pay off my balance in full every month. So that is key, because when you pay it off, they report that to the credit bureaus. There's 3, and I should have wrote these down: Equifax, Experian, and TransUnion. Fact check me in the comments if I'm wrong. I think I'm right though. But we want these credit agencies to say, okay, he or she is doing well with this credit. She's not spending, she's not maxing it out, she's paying it in full. We're not even making any money off of her. When I say we, I mean the credit companies. Because if you leave a balance on your account, you're gonna have to pay interest on that money. So to avoid that and increase your score naturally and organically, it's really important for you to pay it off in full. And if you spend only a certain amount, it's more easier to do that. And if you put the right things on the account according to what kind of credit card it is. Again, for me, with my travel card, only travel related expenses. With my traditional credit card, I might throw a little bit of, a little Apple Music on there, a little bit of this, a little bit of that, but it's still manageable. It's not, again, my whole mortgage. And if you want to do that, great. I just don't do that. So those are 2 points. 30% utilization, and then paying in full every month. You'll see your credit score slowly increase. Trust me. 3 is, and I'm gonna put a testimonial somewhere on the screen of my friend. She's a part of my community, and she was complaining about her score dipping, and I told her what to do, and she is now saying, you know what, that worked, now it's going up. So that'll be on the screen. Number 3 is to pay some accounts off. So there's 2 routes that you can go with this. I'm going to walk you through the first one that I did personally, and that is the avalanche route. So there's the debt avalanche route, which means that you pay off the debt with the highest interest rate first. For me, that mattered because anything with a high interest rate that's not a high yield savings account is bad for you. It essentially means that if your payment is 25, but your interest rate is 5.5, you're spending a lot of money if you don't pay that 25 off in full. If you let it sit there, then that means you're going to be paying an additional 5.5% on the $25 that you could have paid off. So I went after my high interest debt first, my credit first, which is mostly student loans. But there's also another route. If you want to see small wins, you can go the debt snowball route. And what that does is it allows you to tackle the smallest amounts of debt possible so that you see the debt disappear more quickly. With the high interest rate, it took me a while because usually those higher interest rates had higher amounts attached to them. With the snowball method, and I hope I'm explaining this correctly, you tackle the smallest debts first so that you gain that quick sense of achievement, and it inspires you to go after the larger amounts over time. It may take you a little longer, but this is really dependent on who you are and how you move as a person. For me, I don't like giving money away. I don't like giving money away. So comment in the description. Comment below and let me know which route you would be interested in based on who you are. Would you do the avalanche route that goes after the high interest rate related debt, or would you go the snowball method, which tackles the smaller debts and gradually grows up to the larger debts? Let me know in the description which one you would actually consider, or which one you're actually considering if you do have debt or credit that you want to improve. So again, paying these things off in debt helps. It helps, and you will see a drop. I'm not gonna lie to y'all. I want to be honest. This is an honest experience. This is my experience. I did see a drop in my credit score in the very beginning when I did close those accounts, because once you pay them off, at least for my student loans, not for credit cards. This is strictly about student loans. When I paid off my student loans and the accounts were closed, I did see a drop in my credit score, and I was pissed. But what I did is I just did my research. I said, well, hey, how long is this gonna be? Is this forever? And I came across a Budgetnista. I feel like I plug her on every single video. Please follow her if you're not, on all the social platforms. And she told me, you know, it's only for a short term. You will see it rebound. And that's exactly what it did. So that is what I did to improve my credit score. Credit score matters so much to the home buying process. It contributes to what your interest rate is. It contributes to what you're pre-approved for and what loan types you can even consider. And it impacts your monthly payment. A lower interest rate equals a lower monthly payment. Comment that below. That's a good point. People need to know. A lower interest rate equals a lower monthly payment. We want to keep as much money in our pocket as possible. So thank you so much for watching. Please comment below with any questions that you have. Like, comment, subscribe, share this video with anyone that you know has been struggling with their credit and wants to improve it, whether that's to buy a house or just to have it ready for whatever else they want to do with their life. And I will see you on the next video. Peace.